Good morning. Fabian Onetti, week of May 7 to May 11. Fabian again from Winston Capital Advisors. What are we going to talk today? We're going to talk about Argentina, Iran, Venezuela, and the oil. We had inflation numbers for the week, which affected the markets, which affected the dollar. We're going to talk about that. We may have some news on NAFTA, North Korea, mission of China in trade, and also what's coming on this week. So let's start quickly with Argentina. We've been talking a lot about that, and the mission of the IMF finally arrived there, and they're talking about a package of probably $30 billion standby agreement. We think this is very classic. It's no surprises. The IMF will say, listen, cut subsidies, raise tariffs, cut expenditures, raise the primary surplus, and we'll give you some money. Not a big mystery there. The issue is like whether President Macri will have the political wherewithal to get it through Congress and the ministers or whatever he can do by executive decree. So we have lightened up our positions in Argentina significantly. This took us by surprise, so we took a lot of humble pie, sold Argentina. We had equities, and for those clients who wants to stay, we recommend to stay in the short dollar bonds, the 21s, the 24s, not in pesos. There's a lot of volatility there, and you can be trapped when you try to get out, and also not on equities, which will be highly volatile. So that's kind of our thing for Argentina. In a way, we were surprised, taken by surprise, and again, we took a lot of humble pie there. Iran and Venezuela. Iran, no nuclear agreement. That was one of the promises of President Trump. He didn't like the deal. He didn't see how to change the deal, so he's out of the deal. Theoretically, he will reimpose the sanctions that were before, that basically outlaw Iran from handling any single dollar. So no accounts, no banks, you cannot trade in oil, no one in America can trade with you. So we'll see how that affects. Clearly very negative. The allies in Europe are trying to help on that situation. They try to stay, but the United States is out of the deal. The thing is, like, if the Europeans decide to stay, Iran can trade in euros, still a very strong currency, but it won't be able to trade in dollars, and most likely they won't be able to acquire oil technology to keep exploring. As we have learned from Venezuela and PDVSA, getting oil out of the ground is very expensive, and you need constant spending in machinery, tubes, nuts, bolts, and whatever. And most of that stuff is done in the United States. The Russians are very good producers too, so maybe Iran can buy from Russia, but most of the good gear is made in America. As you know, the Europeans have very little oil other than the UK and Norway, but that's mainly offshore oil. It's not the same as onshore oil. So anyways, Venezuela, we have, again, decreasing production, surprising. We had this whole ConocoPhillips saga. Looks like they were awarded a $2 billion arbitration thing, but then looks like ConocoPhillips was able to seize a refinery in Aruba, which was kind of confusing, but it looks like they did, and now PDVSA cannot use the refinery as theirs. There is news also over the weekend that something going on in Curacao, and then there were news on Friday that Venezuela has agreed to pay the money. We know that they don't have the money, so I don't know how they're going to get the money from. I doubted that ConocoPhillips will take an IOU for that award. So very confusing. The reality is that for the first time, creditors have been able to hold into property and tighten on Venezuela. That might prompt acceleration of the bonds. People have not accelerated the bonds because they were getting coupons here, coupons there, so they were in a rush. Now they have learned that they've lost. Had they been able to accelerate, they could have attached some property and have better leverage. So now someone now has been ahead of them. So the saga continues, but on all of this collection of news, people are talking oil at 85 by year end, oil at 100 but next year. And let me jump, since we're talking about that, an article on oil that came in Barron's, very interesting, saying 4 out of the 5 last recessions were done by oil shocks: 73, 80, 90, and 08. Because mainly at that time the United States kind of imported 50% of their oil. So any oil shock will affect price of gasoline right away, consumers, etc. Right now, because the shale oil production has gone up 10 times in the last 10 years, the United States is almost an exporter of oil, kind of a net exporter, depending if you count gas and other things, right? So a shock in oil prices will probably be positive for America, because places like Texas and South Dakota and Houston will be beaming with capex. People will dig for oil, especially shale, which is very expensive to dig. At $80-90 a barrel, it makes a lot of money. You need a lot of heavy equipment, heavy machinery, which will affect positively those economies. So people are thinking it could be different this time. However, for the Europeans and the Japanese, it's not going to be the same story. An $80 or $90 oil will really put in serious danger of recession the European Union and places like Japan and Southeast Asia. No wonder the Europeans wanted to stay with the Iran deal, because sanctions are very negative. Eventually, if oil keeps rising, the United States, maybe because it didn't have that problem, had more freedom to say no to the deal. I mean, I don't, who knows what considerations went in the head of President Trump and his team. I'm just trying to put some financial color into that. So anyways, so that's the story with oil. We had inflation numbers. Both were very below expectation, slightly below the expectation, both PPI and CPI. However, when you look inside the numbers, there is a lot of the components that are decelerating very quickly. Internet services, anything that's related to cars, and healthcare and all that. So the market took a breather. They say, well, listen, it looks like we're not going to have the Fed very rational right now. Yes, they're going to go into their pace of normalization of rates, but it's not. We might not get nasty surprises, at least for now. The bond rallied from 3% to 2.95, and that helped with the great earnings of the super companies of the United States: Apple, Microsoft, Intel, Netflix, Facebook, and many, many others. Got the market that it was down 7% from the peak in January is now 0 for the year. So the market rallied roughly around 2.5%, 3%, depends which markets do you like to see. Europe also rallied more like 1.5%. Asia also rallied more like 1%. But in a way, it was a big rally for the week in which the US is at 0%. And also, the dollar, which has rallied and hit everybody, good and bad, small and big, took a breather. Finally, the dollar took a pause after having some serious rally in the last 2 weeks. We're at 118 on the euro, 135 on the pound, 109 on the yen. It kept rallying yet to the very weak currencies like the Argentine peso, Brazilian real, and Turkish lira. But for the others, sort of took a breather. So, we like this market, as we've been saying. The components on the earnings is very positive. We like it a lot. And also the less worrisome numbers of inflation give us a breather for the market to find a better anchor. We still think that we're hostage of the numbers, both in earnings and in inflation, because that's kind of Fed determinant and also interest rates determinant for the near future. So we will keep an eye on that. June 12th is the meeting in North Korea between Singapore and in Singapore between the leaders of North Korea and the United States. And as we've been saying for a long time now, North Korea has something to negotiate, has a leverage. I have my nuclear weapons to give you. Give me money to grow my economy. Secretary of State Pompeo and South Korean president already said we're ready, willing, and able to help you rebuild your country. You can stay in power. We don't want regime change. You can do whatever you want, but give us the nukes, and we are talking. So that could be key. That could be very interesting. Remember, this is something that's been simmering for years and years, decades, and also always at the forefront of the United States foreign affairs agenda because of these nuclear proliferation problems. We had a big mission of trade coming to the United States. Remember, we went, Steve Mnuchin and Wilbur Ross, heavy duties, went to China 2 weeks ago. The equivalent is coming here. Vice Premier He is coming. I hope I pronounced his name correctly. Is coming this week. There was a mission last week, as far as I understand, but on Tuesday, big names came here to meet more on that. That's the other promises of President Trump, this issue with China trade. That's probably the most difficult to fix, if you ask me. The Chinese are being very stubborn on that topic. They're taking advantages, and the Americans don't like it. And they are trying to retaliate, especially in planes, Boeing, and in soybeans, which is, as we all know, the Corn Belt is a big supporter of President Trump. So we'll see what happens. I think both sides has a lot of leverage to negotiate and to threat, and no one wants to get really bad. But on the other hand, it's a big problem. We're talking about almost a $400 billion problem a year to try to address. So that's there. And before I go, record buybacks for this year. 650 billion announced of buybacks for the S&P 500. The previous record was in 2007 at 589. Of the 650, almost a third of that is Apple, which is impressive. And finally, this week we will have the only relevant number. I think it's Tuesday. Retail sales. We expect 0.4%. The market March number was 0.6, so kind of again a little bit of a signs of deceleration. We will follow. We will report. Again, remember, now we're doing the daily in English every day at 10 a.m. We came in English for our subscriber clients. If you have an interest in subscribing to our service, visit us at winston.capital or email me at fo@winston.capital. Have a great week. We'll reconnect next weekend.